right, guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. And today I'm going to be asking Fabio, you know, Fabio, why do you suck at investing, and what can you do to improve at investing?
Nothing, absolutely nothing.
Nothing. You can't. You just suck, and you're just admitting it.
Yeah.
All right, true. Anyways, with that aside, we're actually gonna be talking about Discovery today. We're gonna be kind of going into the stock a little bit, bringing up some upcoming news, checking to see if any of the business fundamentals have changed. Lately, the price has dropped, and we're going to be kind of exploring some of that, and also just really giving our own opinions on it, whether or not we've sold the position or if we're still holding the position until the merger closes. So without further ado, what are we looking at here today?
So let's address the price volatility first. I think that's appropriate. So with first, when we first mentioned Discovery, I think Austin, you already had a position in Discovery, and then I started buying, I think around what's it, $24. So I'm actually just a smidge down. But we'll kind of talk about this a little further. But the entire market's kind of coming down at the moment. We're gonna release a video just about that. But with Discovery, what's interesting about this position is it's having the merger with Time Warner. So it's going to become one of the largest media conglomerates in the entire world. So until that happens, I don't expect for there to be much movement, because the market is kind of just uncertain about what's going to happen. We do know, as we were discussing right before getting on here, that Michael Burry was selling his position in Discovery. So we're very consistent on this channel, and to say that this is a reason to buy Discovery is an argument from authority. And we discussed in previous videos as to why that's very dangerous for someone to invest in something just simply because someone else is, or sell out of something simply because someone else is, right? Because then you don't know, or you may be doing it for the wrong reasons. And being right for the wrong reasons is just as bad, if not worse, than being wrong. So I think with that being said, let's review some points about Discovery as far as their brands.
Yeah, and also like maybe some of the big catalysts right now, which is a lot of people bullish on this potential merger between Time Warner and Discovery that's going through. Which
let me just kill the joy here.
All right,
that's not going to be until next year.
Yeah, true. So you're buying it.
Yeah, exactly. You can't expect that to really close out until next year. So, or for you to benefit from that until next year. So this is some of their brands in Discovery. If you guys want to go see the Warner brands, I think we'll see in the presentation, but you guys can go on their website and see that. And which we'll go to actually right now. So this is kind of the idea of what's going to happen. So the new company, Discovery, will own 29% and AT&T will own 71%, because that makes sense, because Time Warner is a larger company. Now, if you are an AT&T shareholder, you should be really maybe a little upset, but they are alleviating some of the debt, but they did acquire it for more than what they're letting go of it. I mean, when you include the debt in there, maybe not. But
yeah, and we also got a comment maybe a couple days ago about regarding the debt that this company is going to inherit from this merger. So maybe you could give some of your thoughts regarding this debt right now, whether or not you think that might be a detriment to this deal, or you think that it's not exactly something to, like be bearish on this particular deal for. I'm just curious about your thoughts.
Well, we can take a look at that later, but the debt per se, we'd have to pay attention to how much is the company bringing in. Of course, having that kind of debt is kind of like an anchor to your ability to invest in the business going forward, because you have to service that debt. And if your competitors don't have such high debt burdens, then maybe they have a bigger war chest. Now, in this industry, what is really important is brands. So what brands do you have? What IP do you have? I can tell you that HBO is perhaps one of my favorite streaming platforms. It's one of my favorite. I like Netflix and HBO. I enjoy the content there more than I do on Disney Plus, for example. But not that Disney Plus is bad. It's just really, I guess the content on Disney Plus is not really geared for me or someone like me. So HBO Max is going to be combining with Discovery Plus. Now, here's the interesting part. So it's going to be weird how they navigate this, because they have the brand HBO Max and they have Discovery Plus as separate. So what are they going to do? They might bundle it, or they might keep them separate completely, or they might merge it into one bigger platform. I actually am more worried that that's an area where they can blunder the branding or the marketing of this. So
Yeah.
I'd be paying attention to that, because, for example, I'm a customer, and let's say I'm not paying attention to the stock or anything like that. I'm just paying attention to the upfront brands that interact with me as a customer, and I'm used to HBO Max, right? And I know it's on HBO Max, so you don't want to cause confusion. As weird as that sounds, that's very true. You do not want to, or avoid. You want to avoid causing any mini little tiny confusions within your customer base. Because any little tiny bit does hurt, but it's a risk. It's like, it can work out to the better, but it can also be executed poorly. Okay, so here's what I was promising you guys. Here are the brands that they're going to be acquiring. So Warner Brothers with all that music. DC, which Warner Brothers has absolutely butchered, except for a few movies. Let's all be honest with ourselves. I'm more of a DC than a Marvel fan, but the Marvel movies are superior because of the love they've been getting. Now we'll see with the new Batman. Okay, we'll see with the new Batman, but
yeah, Joker was pretty good.
Joker was
I like
good,
Joker a lot.
but that's
Yeah.
like more of an it's actually weird, because it's not really part of the canon. It's not canon. It's not canonical.
Yeah.
So but Marvel is.
Are you
creating a
speaking heresy
universe.
right now, Fabio?
No,
Are you
I'm
saying
not speaking
heresy?
It was actually if the best, if not one of the best Joker performances, for sure.
Yeah.
But it's not, for example, they're not going to merge it into the new Batman. They're in separate universes. And like they just did the Ben Affleck Batman, but they just threw that away because everything, didn't do so well.
It was terrible.
It was executed poorly.
It was just bad. Just case in point.
The Harry Potter franchise. Okay, that's a big franchise.
Big franchise.
Exactly.
Yeah.
So they have a lot. Cartoon Network, Lord of the Rings.
Game of Thrones is another big one, along with Lord of the Rings. Yeah, The Matrix. CNN. Yeah. It's funny. Which actually, I actually heard that with CNN, they're planning, or at least I read like an article where they were actually planning on making it more like objective news based and less like, leftist opinions and leftist opinion pieces. And I say good on them. Do that. Yeah. The less, leftist opinion pieces, the less opinion pieces and more objective fact.
Wait, is the Zucker guy leaving? That might be inciting why.
Well, yeah. Well, I saw something where I think it was John Malone said that to sell CNN or to spin it off would be like the coward's way out. But that to me just sounds like he's just salty they might lose an opinion piece. So if they can provide objective news, wonderful. I say more power to it.
Well, I'll say I wouldn't want them to sell it because it does provide them with power. It's like Comcast with MSNBC or the MSN networks. It provides you a lot of power, because when you can shape narratives as a company, you can't really. I mean, that's extremely powerful. Okay.
Yeah, but then it also kind of gets into the central premise of almost like journalistic integrity, where you want to present things as objective and unbiased as possible. And right now, CNN's incredibly biased. So that's more idealism speaking than from the company's perspective.
I don't know what you're talking about, Austin.
We're really going to do this again?
The most trusted name in news is biased.
Yes, the most trusted name in news is biased. Yes, they are biased.
Well, anyways, so I think that it would be bad for them to sell it off. Just simply, again, well, Austin's going into the meta or like a deeper talk with CNN. I'm just talking about as from a corporate perspective, it would be unwise or weird for them to sell off something that can be a great tool. And that might sound bad, but it's true. Mm-hmm. It is true. They're advertising the Synergies. So basically, you can think of the $3 billion of Synergies. So we'll come back to that later. But these $3 billion in Synergies alone will help them pay off that debt. Okay, so that makes the debt less scary. And we don't know, but here's the risk. Well, I'll get to the risks when we get to the model. I'm just going through this. Okay, this is for AT&T. This has nothing to do with us because this is a joint presentation. So it has nothing to do with us and Discovery. All right, so I
Mhm.
think we're finished with that. So any comments before we pitch into the model?
No, I think that we should probably take a look in that model right now and just kind of see if things have drastically changed with the model. I remember you mentioning earlier that you had to do a little bit of math in regards to the model, so maybe you could
Yeah,
explain some of that for
yeah.
some of our audience
Discovery's
members
one of
as well.
those.
Yeah.
Discovery's one of those. All right, so when we get into the model, um, you may have noticed some things have changed, Austin.
Yeah, it's oh wow.
Yeah, well, we'll go over everything. So there was the
Yeah.
video that was released with the cruise liners, and I kind of showed off some of these new features.
Yeah.
So some of them are, fairly basic. The ones I'm actually going to use a lot are going to be the recovery calculators, and something new added. But I'm going to say this now, and then people are not going to listen to me, but I'm going to say it because I need to say it. This tab right here, it is a flagpole. Do not follow it literally.
Yeah. It's just a
as all of
place
these,
by
okay?
which, it's a
Yeah.
point of reference.
It's a point
Yeah.
of reference that helps me make decisions.
Yeah.
Okay, so this is now in the model, and it will tell me based on my assumptions, based on the risk that it sees, and with the blah blah blah, the stock. We'll leave that in there, the blah blah blah. People like that, I guess.
Oh yeah. Yeah. Just we're leaving it
So,
all.
the recommended portfolio weighting is basically telling me how much of my capital to put in, and it's regardless of portfolio size per se. So it's kind of universal. So
Yeah.
but it's highly dependent on all of these things being true, and it actually has nothing to do with the future risks. It's more about pricing it in today. So for example, if the stock price continues to go or downtrends even further, this measure actually will start to increase automatically. And it'll be telling me, hey, you should probably actually, again, assuming some of these assumptions, you should probably add more. And it's including this discount rate, because watch, if we change the discount rate, you see how it does
Yeah.
it? You
Yeah.
see the
It
beauty?
changes a
Yes.
lot more.
So I won't do a video on that specific math going on there, because that's its own thing. But in this video, it's just going to be about Discovery. So I'm using weighted custom weightings. So basically I created like a bell curve on my assumptions from 1% to 20%. I'll explain where this 20% comes from. And it actually just, it comes from here. So we can change this live, and I can say we change this to 5. So now the middle term becomes 12, and going back, remember 3 is 20. So that's kind of where this central point comes with the 3 and the 5. So over the 5 years, it's averaged out around there. And so we're going to put 10%, right? Slightly lower. And then, but the weightings are going to be a little bit higher on this end, because I'm assuming that with Time Warner, there's going to be some synergies, etc. So I'm adding that in there. This is not really in a recovery moment. And oh, I also added this little joke here, Austin. You'll probably love this. So let's say I'm a doofus and I put 10%. But it also helps you not be a doofus, and it tells me, hey, you got to take away 5%. So,
Nice.
looks like I passed middle school math, right?
Nice.
And I can add and subtract percentages.
Yeah, I saw that at first, and I was like, oh wow, you really did make some changes to this model, didn't you?
Oh yeah. Oh yes. And then there's one bigger change that's coming. But yeah, these are all like extra tools that help me, make my investment decisions. So this stuff is kind of like just scraped, right? Austin knows about this. So all this stuff is pretty basic stuff. So we can use this. It's not really important to have. It's just like there, so I can compare quickly to what the aggregation of analysts say. So the aggregation of analysts say hold, but a price target of 37.95, which would imply a 63% upside from here. And then nothing else really matters on a given day. But I already did a video kind of going over this. This is in the cruise line. This is more or less Austin's back from his trip. So he's seeing this for the first time. This is raw, ladies and gentlemen.
Yeah.
All right.
I went up to the University of Florida and saw that UF FSU football
Look at
game, which
you
was a lot of
given
fun.
locations. You're not
Yeah,
scared. You're not
well,
afraid.
no.
Dropping
No.
locations. All right. So also for my added convenience, basically as I imply my required rate of return, it also gives you your implied return. So that should have been there from the get-go. Very simple little thing to add, but so example, I put 20% gives me that 519%. So very easy for us. And then here we're doing 15%. So at 15%, it actually seems like a buy under most circumstances, and it is allowing me, or the model is recommending me, to put about 6% of my portfolio into this company, if this is a company I decide should belong in my portfolio. Now, what do you notice that I'm assuming, Austin? Do you notice anything? I'm actually highlighting it right now.
You're assuming share dilution in this.
Yes, I am.
In this instance. Yeah,
I
and
am
a lot of
assuming
it
share
too.
Yes.
You're assuming 4% over the next 10 years.
Yes.
So
the company currently is not paying a dividend, so they don't have that actual cost or burden on the business yet, and they're not dedicating themselves to pay a dividend as of now, or as that I know of. But I do think that the stock price is cheap relative to the earnings, and actually we'll get to the earnings and the extra math I had to do. But and actually I'll remove this to avoid distraction. The dilution of 4% is going to be more costly if the share prices are quote unquote cheap, which I think they are relatively cheap, right? Relatively. And if we want to take away that dilution and say there's no need for that dilution, well, now we're in business, right? And before anyone maybe asks this question, there is a dual class, or I think maybe even 3 classes of stock, but there's multiple classes of stock. And what I had to do is I had to adjust the numbers for those additional classes of stock, because we don't actually, if I take all of the class of DISCA, so if I take all that stock and you use the actual income of the whole company, you're going to get some outrageous number. Like it's making a stupid amount, because I think the market cap of all of the A shares are right in here are $4 billion, right? But the market cap of Discovery, if we just take a look at a resource like Seeking Alpha, is about 16.
Okay.
So yeah, that's a little bit that we need to discuss. I think this one's actually
all right
from
so my next question to you is, has your opinion on this position changed? Do you plan on selling? Do you plan on buying more, adding more to this position? What are you thinking? Because me personally, I'm not going to sell it anytime soon. The price decreases are not really enough for me to sell. Couple of investors selling off is still not enough of a reason for me to sell. I have confidence in my initial analysis I made and my initial decision to invest in this company. So I'll stick by what my initial decision was with this. And if there's an actual change to the fundamentals, or if there's another event, like let's say the merger just doesn't go through, then I would reconsider. But as of right now, I'll most likely continue to build onto this position. What about yourself, Fabio?
Yeah, I mean, I'm going to be nibbling here and there. Now I'm going to be nibbling a little bit more than before. So I'm probably I'm sticking to that 20% discount rate. So what it says, so it's only going to reach about 2% right now. If it continues to go further lower, then it's going to slowly but surely actually go up in terms of allocation. If the fundamentals don't change, because even the model will only assume that if the fundamentals don't change. If the fundamentals change, their percentage will actually reduce, not go up, even if the share price is going down.
Yeah. Well, so with that being said, do you have any closing thoughts before I wrap up the show here today?
No, I think we're all set.
All right, perfect. Well, we are your hosts with the most, Austin and Fabio. If you've liked what you've seen here today, please be sure to share the video. It really, really helps out the channel. Please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. And this is the Capital Mindset Show, and we'll see you guys later. Take care.